Financing the business. Every company needs cash to function. Although a business owner's savings may be enough to get a firm up and running, many firms need to find additional sources of money to survive and grow. A business has a variety of options to raise additional money, or capital. Many new and existing businesses finance their purchases through secured loans. Secured loans are generally used to purchase long-lasting assets such as vehicles, equipment, and real estate. In a secured loan, the borrower promises to repay the loan to the lender. Loans require that the borrower repay the loan based on a pre-agreed schedule with interest. In the event that the borrower is unable to repay the loan, the lender has the right to seize the assets securing the loan to recover what they are owed. Banks may also be willing to make unsecured loans to certain borrowers. As with a secured loan, the borrower repays the loan based on a pre-agreed schedule with interest. However, with an unsecured loan, the borrower's promise backs the loan, and a lender will have a more difficult time collecting what they are owed if the business is unsuccessful. However, companies in good standing will find that lenders will be willing to loan them money. Another option for financing is the use of angel investors or venture capital firms. An angel investor is an individual who is willing to provide new capital to a firm in return for a share of ownership. In addition to a share of ownership, these investors may want a say in how the company is run. Similarly, venture capital firms pool the resources of individuals and companies to invest in companies that are expected to grow in return for a share of ownership. While using an angel investor or venture capital firm may mean giving up a share of the company, the amount received does not have to be repaid. Many corporations and governments raise money through the sale of bonds. A bond is simply a loan that has been packaged as a security that can be bought and sold. Just like a loan, a bond requires a fixed repayment schedule and pays interest. Corporate bonds have been traditionally issued to fund major projects. The advantage of bonds is that a firm may raise a large amount of money without giving up a share of ownership in the company. However, like loans, bonds must be repaid, so the corporation must generate enough cash from the investment to repay the bond in the future. Finally, an initial public offering of stock offers the greatest potential for bringing large amounts of money into a company. While selling stock means selling off a part of the company, the potential to raise millions or billions of dollars allows companies to rapidly expand and achieve economies of scale. In addition, unlike loans and bonds, stock never has to be repaid. A company wishing to grow must carefully consider the various sources of capital: secured loans, unsecured loans, angel investors, venture capital, corporate bonds, and stock. Each source has its inherent advantages and disadvantages, but all provide the opportunity for a company to expand and succeed.